Imagine a scenario for me. It sounds like something out of a financial horror story, but it's very, very real.
Okay.
You've been in your home for, let's say, 15, maybe 20 years. You made it through the 2008 crash. You got through the pandemic, and you're finally sitting on a good amount of equity. You think your financial slate is clean.
Right. You feel secure.
And then a letter shows up. It's from a company you've never even heard of, claiming there's a lien on your house for a debt you were sure was dead and buried a decade ago.
Yeah.
And they're not asking for a small amount. They're threatening foreclosure.
It is a situation that is completely blindsiding homeowners who thought they had all their ducks in a row. We're talking about zombie mortgages.
Right.
And, the name sounds like a B movie, but the reality is this is a very sophisticated, high-stakes play in the distressed debt market.
Exactly. So today we are diving into a really comprehensive report from Bankrate, and we're pulling in some key insights from consumer law attorneys as well. We're going to break down how these debts survived the Great Recession, what's causing their, resurrection right now.
And the really specific legal loopholes that allow this to happen.
Yeah, it's a fascinating, honestly, a pretty unsettling look at the life cycle of debt. Because these aren't just mistakes. This is a systemic feature of how some of these loans were handled during the housing bubble and how all that old paperwork is being monetized today.
It really is.
So to understand the zombie, we have to go back to the environment that created it, the early 2000s. This was the era of loose credit and specifically the piggyback loan.
Ah, yes, the famous 80-20 split.
It was almost a way to game the system, wasn't it? The whole point was to get around private mortgage insurance.
Precisely. In a normal world, if you put down less than 20% cash for a house, the lender makes you get PMI to hedge their risk. But during the bubble, lenders and brokers found this workaround. You'd take out a primary mortgage for 80% of the home's value, and then, at the same closing, a second mortgage, the piggyback, for the other 20%.
So the borrower gets in with zero down, they avoid that PMI payment, and the lenders get to write two loans instead of just one. It's a win-win, or so it seemed.
And that second loan, that 20% piece, that is the key. It was usually a home equity line of credit, a key LOC, or maybe a fixed-rate second. But crucially, because it was second in line behind the main mortgage, it had a higher interest rate to account for that extra risk.
And that second in line part, that subordination, that becomes the fatal flaw when 2008 hits.
Oh, yeah.
The market just crashes, home values plummet, and millions of homeowners are suddenly underwater.
Correct. And underwater is the key term for the lenders, too. If your home is worth, say, $300,000, but your first mortgage is for $350,000, there's absolutely zero equity left to cover that second loan.
Go from a collection standpoint, that second mortgage it's effectively worthless.
Completely.
If the second lender tries to foreclose, the first lender gets paid first, and there's nothing left for them.
Exactly.
Right.
It became a dead asset on the books. So the banks holding these notes, they made a simple balance sheet decision. They charged off the debt. They stopped sending statements. They stopped calling.
Because it wasn't worth the postage?
It wasn't worth the postage to collect on a loan that had no collateral backing it anymore.
And this is the critical point. This is where the confusion starts for the homeowner. Because silence, to most people, feels like resolution. You stop getting bills, you might have even modified your first mortgage, and you just assume that second one was, forgiven, wiped out.
It's a very logical assumption to make, but it's also legally a very dangerous one. A charge-off is just an accounting term for the bank. It means they move the debt from an asset to a loss, for tax purposes.
It does not mean the contract is void.
Not at all. Or that the debt is forgiven. It just means they've stopped actively trying to collect it. For now.
And this is where the secondary market, the debt buyers, come into the picture. Because the banks didn't just throw this worthless paper away.
No. This is the part of the industry most people never, ever see. These non-performing loans get bundled into these massive portfolios. We're talking millions of dollars in debt, sold to hedge funds, debt buyers, speculators. For pennies, just pennies on the dollar.
So a debt buyer might see a portfolio of second mortgages with a face value of, say, $50 million.
Yeah.
And they might pay, $500,000 for it? They're basically buying the option to collect. Your home just became a lottery ticket.
That is the perfect analogy. They bought these notes knowing that maybe 90% of them would never, ever pay out, but they can afford to just sit on them. They wait. They don't need all of them to pay off. They just need a few.
Just a handful of homeowners to recover financially, and they make a massive return on their investment.
Exactly.
Which brings us to today, the why now question.
It's easy to just say home prices went up, but it's more systematic than that. It's about data and technology. It really is. Think about the tech debt. In 2010, trying to track the equity of 10,000 individual properties would have been a huge manual effort.
Right.
Today, these debt buyers use automated valuation models, AVMs. They have algorithms running constantly, scraping data on their entire portfolio.
So it's not some guy in an office manually checking your Zillow page?
No, no. A server is pinging Zillow, Redfin, county tax records every single month automatically.
Wow.
And that algorithm is just watching one thing, the loan-to-value ratio. The second your home value crosses a certain line, where there's enough equity to pay off that first mortgage and their second lien,
Once the system flags your file.
a red light goes off.
Yeah.
And the zombie wakes up.
And because they bought that debt for next to nothing, their profit margin is just enormous. But let's talk about the homeowner side of this, because the shock isn't just that the debt still exists, it's the balance. It's the number on the page.
This is the real horror of it. It's the compound interest. You have to remember these second mortgages often had interest rates of like 9, 10, maybe even 12%.
And while the lender was silent for 15 years,
That interest clock never stopped ticking, not for one day.
the bank rate report had this one case from an attorney, Audrey Powers Thornton. A homeowner had a ELOC. The original amount was $95,000.
Yeah.
When the demand letter finally showed up all those years later, the balance wasn't $95,000.
Let me guess. It was way, way higher.
It was over $400,000.
Wow. That is staggering.
A staggering multiplier. And these new servicers, companies the homeowner doesn't recognize at all, they're demanding the full amount right now.
And they have leverage. This is where we need to get into the legal weeds a little bit, because this is where the fight really happens. Most homeowners think, wait a minute, there's a statute of limitations on debt. You can't just come after me 15 years later.
Right. In most states, for a written contract, it's what, somewhere between 3 and 6 years?
Yeah.
So how is this even legal?
Okay, this brings us to a really critical legal distinction. It's in personam versus in rem liability.
Okay, let's break that down. In
Yes, yes.
personam, that means against the person.
Correct. That's your personal obligation to pay the money.